All right. Welcome, everyone. Welcome to another episode of the Money Classroom. I am your host, Keisha Bailey, also known as Keisha the Teacher. Class is in session. So, no matter your age, stage, or wage, you are inside the Money Classroom to learn how money works and to take away these lessons to make your money grow and work for you. For those of you who are new to me and new to this channel, I am Keisha Bailey. I'm an investment strategist and educator with over 18 years of experience in the local and international financial sector. I've managed billions of dollars on behalf of clients, and these days I'm living my passion for empowering individuals just like you. And I'm on a mission to help investors to turn the money you have into the money you want. Don't forget to head over to my website, profitjumpstarter.com/newsletter. Once this live show has ended, to make sure you're getting weekly tips and strategies around investing delivered right to your inbox. Also, when you sign up for the newsletter, you're going to get the free Multiply Your Money Guide. The Multiply Your Money Guide has every single thing you need to be able to eliminate your money problems and to learn how to build wealth faster so you can reach financial freedom, because that's what everybody wants, right? Financial freedom, money, all these things. So if you haven't subscribed to the channel as well, make sure you hit that subscribe button right now. Hit the subscribe button. Make sure you're subscribed to the Profit Jumpstarter YouTube channel. Also, tell your friends, tell your family, anyone that you want to bring along this wealth building journey with you. Tell them to come and watch the Money Classroom. So you know the drill. Where is everyone joining us from tonight? I see everyone's active. I have a big turnout with us tonight. Let me know which part of the world are you joining from, where you're rolling in from tonight inside the Money Classroom. And of course, let's jump right into our disclaimer. The information provided on this show is for general entertainment and education purposes only. No information, materials, services, and other content provided on this show constitute solicitation, recommendation, endorsement, or any financial investment or other advice. Seek independent professional consultation in the form of legal, financial, and investment advice before making any investment decision. All right. So we have somebody here from 12 o'clock today, sitting down waiting. Nala Henry saying, can't wait. She's been on waiting from 12 o'clock. Big up yourself, Nala. Welcome to the Money Classroom. Cheesy Gully side, you don't know. Big up yourself. Keisha the Teacher, love the show. Know me ready for Money Classroom. Fiona from Kingston, welcome. Christine, hello from Kingston 19 as well. And Ingrid, big up yourself. Welcome to the Money Classroom. Tehran as well. Money sense is up with the teacher. Big up yourself. And Sashi, good evening, Keisha. I'm here from Yala St. Thomas. Welcome. And Roxy from Bermuda. Ingrid tuning in from St. Andrew. So welcome, everyone. Pull up your seat, take out your money book, and get ready to take notes. Now, let's get into tonight's show. The International Monetary Fund, IMF, predicts that global growth is going to slow down next year. It's already been a slow year, but the IMF is saying, get ready, 2023 is going to be slower. That means global growth is anticipated to be around 2.7%, lower than the 3.2 that it is now. So what should we do then in 2023 with our money? What are we going to do? And that's what this episode tonight is all about. It's our last episode for this season, and I wanted to make sure that we end the season with everybody being ready for 2023. We're coming back in 2023 bigger and better, but we need to leave you with enough to think about for the remainder of the year so you can start making your money plans for 2023. Now, tonight we're going to be joined by a very special guest, Julian Morrison, and we have inside the show and tell segment, Clive Charlton, equity trader from JMMB. We are going to be talking about what exactly happened in the global economy that includes Jamaica and international. What happened in 2022 and what can we look for in 2023? And more importantly, what moves should you be making with your money in 2023? I want you guys to be very active in the chat, ask up all the questions, because this is a very, very important episode for us, because we need to make sure that everyone understands what to do come 2023, January morning. What should you be doing? So I'm going to jump into the lesson. Come join me on the money side. The lesson is here. Take out your money book. Get ready. All right. So I am going to give my take on the 2023 global economic outlook. And one of the first things I want to provide is a background. What's been happening this year so far? 2022 has been very eventful, very tumultuous, and it's not even over yet. We still have about 6 weeks left in this year. A lot can happen in 6 weeks. A whole lot can happen. And with 2022, we've been struggling with rising inflation all over the world. The price of everything, everywhere has been going up. There's also been a lot of uncertainty. We don't know which way to turn because we've had the war. Remember, the war between Russia and Ukraine began in February, and that war is still going on. Still from February all the way to now, that war is still continuing. We also have supply chain problems, and those supply chain problems have been made worse because of the Russia-Ukraine war. These together all impact our global economic outlook, the impact of what the future holds. So 2022 has been a year of very high inflation. Everywhere across the world, we've been seeing record high levels everywhere, right? And because of that, these higher prices has created a slowdown in the economy because things have become so expensive that, you just turn your mind and say, I'm not going to make that purchase anymore, or I'm going to just delay that purchase. Remember when we started the year, it was outside a keep, everybody out, because, we were starting to see signs that the pandemic could be behind us. However, even though outside a keep, outside was very expensive. So even though it's a keep, we couldn't really go out with much because it is expensive. So inflation continued to be a major problem for all of 2022. It still is a big problem. We've seen signs of inflation coming down in different countries, but it's still very high compared to historical levels. So this chart right here is from the IMF, and it's showing a global heat map, as they call it, of inflation numbers across the world. Notice everywhere is mainly red because inflation has been a problem all over the world. And that's what this chart here is showing. Inflation is affecting all countries globally. Now, 2022 has also been a year of war and a lot of uncertainty. With the cost of living problems we've been having and tightening financial condition because interest rates going higher, the war between Russia and Ukraine just made things worse. And also the lingering pandemic. Remember, in China has a zero COVID policy that is still in force. There's still a lot of restrictions and a lot of lockdown happening in China. And we know everything is made in China. So because of that lockdown, it's creating more supply chain problems. And the war as well is exacerbating a lot of these supply chain problems, which means higher prices because things are scarce. And we're seeing it in the inflation numbers. Now, this year has also been a year of higher interest rates. You feel it in your credit card bill, you feel it with your mortgage, you feel it with your short-term loans. And for those who have their money in a high interest savings account, they're benefiting. We spoke about that earlier this year. Still a way that it was a great year for persons with high interest savings account. But on the flip side, if you have a lot of debt, 2022 was not your year because the debt would have been a big stressor in your life, because the cost of debt became more expensive. Interest rates went up. All central banks, Bank of Jamaica, the US Federal Reserve, Bank of Canada, Bank of England, everybody was raising rates, and they still continue to do that. These high interest rates are felt mostly with loans and with debt. So lots of problem there. So when we think about 2023, I want us to think about these things. What is global growth going to look like? Is it going to pick up? Is it going to slow down? So far, the research coming from the International Monetary Fund is that global growth is going to slow down. Inflation, what's going to happen there? Is it going to continue to go higher? Is it going to trend lower? We have the experts with us to talk about that. And then we have to think about interest rates as well. Is interest rates going higher? Are they going to stay the same? Can we put down some of these rates so that, we can just take a breather from all of these high interest costs? And then when we think about investments or stocks and our bonds or mutual funds or unit trusts, what will happen for them next year? Are we going to see another year where, like in the US, we had major downturn in the stock market? We had the stock market enter into bear market territory, meaning a bigger contraction. And is that going to continue next year? We're going to hear from the experts. What's going to happen to fixed income? What's happening to unit trusts? We want to know so that we know how to position our money. Also, cryptocurrencies. Cryptocurrencies have been down more than 70% this year. Is now the time to buy cryptocurrencies and get into that hot new trend? We're going to hear all about that when we bring on our guests. These are the things. So I want us to make notes. When we think about 2023, we want to know about global growth. We want to know about inflation. We want to talk about interest rates. We want to look at our investments and how to position them. And we want to look at cryptocurrencies as well. Should we be going into the hot, new, sexy cryptocurrencies now? Or should we just sit and wait out on the sidelines? Should we be buying stocks? Is now the time to go buy some Apple and Amazon and Microsoft? Or should we just want to wait and hold our money under our mattress? What should we be doing? We're going to be looking at all of that. Now, so far, these are the global growth projections coming out of the IMF. As you see, the bars are heading down. So what we know so far is that global growth is going to take a hit. We know that for sure. Global growth is going to take a hit. And I want to make sure everybody gets to see bigger. When we see the numbers, global economy, we're going from 3.2% in 2022 to 2.7. These are the forecasts. The advanced economies, the developed countries, growth coming down there as well. And developing economies like Jamaica and the Caribbean, growth they're saying is going to be roughly the same. So not as bad as the advanced economies, but still not really one. When we look now by region, we want to look at the purple charts here, Latin America and the Caribbean. What's happening? Lower growth there, right? So we have to figure out, with lower growth expected, what should we do? What are we going to need to think about? What we need to do with our money, right? I've set that up so you can understand what is to come. And now we're going to be heading into a discussion around, all right, how do we position ourselves? Now, this week, I wanted to just end with the IMF outlook, and this is coming directly from the IMF. They're saying the challenges that the global economy is facing are immense, big challenges, and weakening economic indicators point to further challenges ahead. I'm seeing the word challenges, and I've seen challenge, and I've seen challenge. I've seen hard times. Adding to that, the current policy environment is unusually uncertain. So we have challenge and we have uncertainty taking with us into 2023. What should we do? What should we do? That's what we're going to go into. We're going to have that discussion. We're flipping things around a little this week. We're bringing the show and tell segment first because we want to hear from the licensed financial advisor what we need to do with our money. With us tonight, we're going to roll now into our show and tell segment with JMMB. It's now time for show and tell. So the show and tell segment is brought to you by our sponsor, JMMB Group, and here to help us stay ready for 2023 and to get ready and to make our notes in our money book. We have brought a licensed financial advisor that we can ask anything, and that person can tell us anything. That person is the expert, Clive Charlton, who is equity trader at JMMB. Welcome back to the Money Classroom. Clive, big up yourself.
Thank you, Keisha. No, I'm trying to. Oh, okay, yes, okay. I'm not too versed on this computer thing, so I have several
You're
tabs
on.
open, so trying to find here.
You're on. And
Okay, thank you
everybody is
for.
waiting to hear what is
Okay,
Clive
and
going
can
to
you hear me?
say. What are we going to do? So let's start by your version of the recap of 2022 in the financial markets in Jamaica and internationally. What did you
Okay.
see from your perspective being on the trade desk at JMMB?
Yes. Okay. Well, interestingly, what has happened on our market is slightly different. It moves at a different pace, and there are different factors that drive our local economy than the global economy. And what I like to look at, I believe, has happened to our market. We're coming over the last, I would say, 7, 8 years. We have seen some level of stability in our marketplace, interest rate trending down. So we're coming from a high teens, 20%, 17, 15% interest rate environment, inflation much higher. So it has not impacted us that badly. Also, just prior to that, our bauxite sector went into a decline, and that now, Jamaica is now up. In other words, we were moving at a much different pace than the global market. We know the global market impacts us. Yes, we import almost everything, right? We know, in fact, a lot of our purchase of our bonds are also foreign entities. Everything is impacted. Remittance, we know that, right? But interestingly, our market has had some conditions that has kind of I would say, put a drag on our economy. So we weren't declining at the pace that the US was. And also, just recently, I think our economy continues to do fairly well. We're still at the edge, but fairly well. So much so that the Bank of Jamaica governor says that he raised the policy rate, the base interest rate at up 50 basis points. And he says at that point, at 7 percentage points now, he may put a pause, or there may be a pause on it.
So we're seeing a pause in Jamaica then in terms of interest rate hikes.
Yes.
Meaning then for everybody on tonight, don't expect any more interest rate increases in Jamaica for, I guess, the next little short while, however that short or long that may be.
Yeah, and I would still say for the next quarter to 6 months, even though the MPC, they meet
3 to 6
every month.
months.
Right, I said that, right? But there are a lot of dependencies here. The US economy is important to us. That's our major trading partner. I mean, our economy is heavily dependent on the US. Major trading partner are tourism and remittance. Huh? Yeah. So we're heavily dependent on them. There are some who believe that the US may go into a recession next year. I think it's kind of 50-50 based on my readings. Right? But the US is very resilient. Let's see how Fed rate goes next year. It's predicted, and Powell has indicated that it may slow down next year also. So again, I think they may be putting a break, not a pause like us, but a break on the Fed rate, right? So that could aid somewhat the economy. We also see slow down the effect of the high interest rate environment in the US. We've seen the effect that is desired, which is a slowdown in demand so far.
Well, so you believe in the US as well, we could say a pause in interest rate hikes?
I would say a slowdown. I wouldn't say a pause. We can pause because there are critical factors in our economy that is working now. For example, Jamaica has just opened up. Tourism is still rebounding and growing, as a matter of fact. They are adding rooms as we speak. They are seeking heavily labor workers for the sector. They're seeking higher skilled workers for the sector, which means an increase in pay. You see? That is important for the economy. Our agricultural sector is doing fairly well. Also, it has rebounded apart from the heavy rains we have had earlier. So those 3 critical areas are doing well in the local market, you see. And I believe also psychologically, even though interest rate has been going up, because we're coming out of a previous 30 plus years of high interest rate environment, I think psychologically, this is bad, but not so bad as it was before.
Those days of the 30% and 20% interest rates, they were there, but you're saying no, that you believe because it's still high. I mean, it's not 30, but it's still high relative to probably the last 5 to 10 years. It's still high.
Still high. You see? And in terms of my market now, the equity market, the psychological, you talk about business confidence and consumer confidence, and we say in the newspaper the published business confidence index. And sometimes I might say, well, that really, if money now around, then we talk about confidence. But when you decide to jump into an area, either for business or to consume, there's a mindset first. You see? Now, interestingly, I believe that our market now, our equity market, our capital market has just awoken also with our local economy in the last 6-7 years with the decline in interest rate. People are now coming to the stock market.
More so people you're saying the stock market is where it's at?
It is, even though the indices have slowed down over the last month and a half, probably 6 weeks or so. Yes, even though the volume traded is not too bad. On average, every week, we see consistently probably 100+ million units traded compared to 3-4 years ago. On average, it was like 80 to 75 million units. Now, just in probably August, September, it dipped to about 100, between 90 and 100 million units. It's now back up for the last 4 or 5 weeks, up to 120 million units traded. The participation, though, over the last number of years have increased. That is the number of persons in our market. But what is that is on the investor side. What is interesting, though, is that more people are coming to the market to raise capital.
Yeah,
it's still cheaper than borrowing. It's less stressful than borrowing. And then when you have people participating in your economy, in your company, I think people are more mindful of buying up. When I go to the supermarket, I'm telling you, I look for the goods from the companies. I put more of my disposable income. Yes, I do. Right? So
that's a good plan, and we can probably say that. So if equity trade at JMMB is saying, I buy goods in the products I invest in, companies are some of that and implement in our life as well.
Yes, we should. So it forces more people to come to, especially these long-established family-owned companies, right? But the psychological part of it, though, financial, more companies are still coming public, to raise capital. As I've stated in another program, where in Jamaica can a company in an IPO get application in excess of 24 billion Jamaican dollars? Which single bank in Jamaica can forward a loan of $24 billion to any one company? I mean, there are regulatory requirements that would prevent that. From if one bank should try to do that, you expose yourself too much. But a company can come to the market and get application for 24 billion. So
let's talk about the IPOs, because that you're kind of heading there, and I'm sure everybody will know. Is 2023 gonna be a year where we should consider more IPOs? Should we? Because you said there's resiliency, companies coming, and people and companies need capital. That means to me then IPOs coming. Should we be looking at those as investments?
I think so. In fact, there's one just published on the JC website, Regency Petroleum. I believe we're not looking at the figures as yet, right? And that's a very young company, but I believe so. Why? Capital is just easier. As interest rate goes up, banks, of course, we see adjustment in the loan rates, and there's a squeeze now on quite a number of debtors, right? So they will think of going to the market where it's a little bit cheaper, almost unlimited amount of, I wouldn't say unlimited, you know what I mean, right? But I mean, what they can get in the market is much easier and larger than what they can get in the.
And then because of that, then we should expect more IPOs.
I would expect more IPOs.
We get ready for that. So Cheesy Gully Side has a question. He's saying, Clive, should we just build up an emergency fund and be a bit more careful with equities?
Good. In fact, we have been saying from good while back that build a cash reserve. That is, of course, we expected some pinch on the market. We did speak to the financial sector in Jamaica. If you understand the relationship between interest rate and financial products, for example, interest rate on a bank, what does a bank do? It takes your money, it pays you a rate on your deposit, and then it offlend that money to someone. When it offlend that money now, interest rate is going up. That is being squeezed, its ability to generate revenue. According to the BOJ, the non-performing sector of loans is improving too. All the metrics in Jamaica seem to be improving. But the fact is that profitability is still being squeezed, especially in the financial sector. NCB proven, and of course JMMB just announced that they are going to retain cash. So in, temporarily they will reconsider paying dividend this period. That is okay. That is normal. That is in the long-term interest. NCB did it much earlier this year. We saw the stock price declining considerably, but we saw the last published results. Significant jump in profitability.
Yes.
So the steps they had taken much, much earlier has generated a return. Their profit is now much higher than it was at the peak 3-4 years ago. Third, nearly $40 billion net profit. Of course, some of that is attributable to Guardian holding a significant that, but the fact is though is that prices have declined. So we were telling persons that when you liquidate, hold the cash. Hold cash for opportunities when we believe that the market is at its lowest. And now I think we can go back into some of those securities. Still a little cautious.
You think that's now is the time? So 2023, get ready to start buying
IPOs as well as to buy back. Yes. As well
IPOs as to get back and buy shares.
Reposition into prices that have declined. Right?
So 2022, guys, we're hearing it. Get out your money, get your money ready. 2022 is the year of slowly starting to buy back, buy IPOs, buy companies that the prices are falling a lot.
And
coming from the financial advisor.
Yes.
Point that out. You never hear it from the licensed professional. But so Ingrid has a comment for you. Ingrid is saying she's staying away from all of these $1 IPOs.
Here's the thing with Wonder. I wonder why. But so nonetheless,
she has made a decision.
I know. I think I know. Maybe I could guess why. But here's the thing. It's not the price so much. But I know what you mean when it's a $1 IPO. It's not the price so much. What these IPOs have done is to, importantly, when a company is coming public, right? It's not necessarily the price that they come public at. It's the value of the company. But what they have decided and realized is that people react more to the stock price that is priced at $1 than the stock price priced at $20. So the company could be valued, let's say $100 million. Now, you want to come public, you can divide it into 100 million shares at $1. You can divide it into 1 million shares at $100. It's the value of the company first. Later now, you decide, how do I price it in order to attract investors? So it's a value important. $100 million company, two companies, A and B. One, bring 100 million shares at $1. The next, bring 1 million shares at $100. So what it does now, the 100 million shares at $1, is that it has this effect. It's a kind of a money illusion effect, where people believe it's cheaper than the $100 stock. You see?
But that works for the company doing the IPO because
they raise more capital.
Or subscription.
Exactly. And also what it does too, I think it enhances the speculative part of the IPO now. Because it is $1, the investing public will easily ratchet up that stock to $2, to $3, to $4. They wouldn't do that to the $100 stock. By the time they put on $10, 10%. No, I'm not buying no more, right? But the dollar stock goes up to $4 or $5. But guess what? They have now moved it from a fairly priced dollar stock to now a significantly overpriced stock. And the thing is that persons who come in after, in that speculative buy, when it reaches $2, they say, if it reaches $2, it must reach $3. Bam, them coming at $3. It's already overpriced. If it is fairly priced at $1, the IPO, what has happened between 1 and 2 or 3 days or a week to cause the value of the company to go up so much? That's a question you should ask yourself. So I believe that there are quite a number of persons who are buying at this elevated price in the speculative.
Lots of speculation.
And they got burnt out there. Now, here's the thing now, what you do. Two things you can do. You can sell, realize the loss, and go into other opportunities. But right now, we don't see many opportunities now, right? 1 and 2 IPOs coming. Prices are falling off, right? Or you can decide that, okay, I'll hold that stock, but my period is longer. So if my expectation was to buy it and hold it for a year or two, you may have to hold it for 2, 3, 4 years. But here's the thing. The good thing though is that these companies are growing rapidly. A new company, a junior company, especially one that is properly managed, and you can read in the newspaper and see what is happening with the company, how they're diversifying into different. Let's talk about Fast Rich. One little light bulb and electrical thing. And look at it now, manufacturing, big time manufacturer, PVC pipes. There's a growing demand for construction. JPS, who used to export the repair of their significant diesel thing that they use on the poles, are now being repaired here. That's a significant add-on value. So the point is that these companies can grow, but portfolio allocation, right? Don't put the eggs in one basket.
So you're giving, and I have to preface this now. You say portfolio allocation. You're going to talk about sectors that we must look at, different areas and so
that's
forth.
what we should do.
All right, money book time out. Let us go. What are the areas you're saying?
Well, here's what I said. First and foremost, look at the portfolio now and divide it into sectors. Look at the balance sheet of most companies and they'll put them into sectors. For example, there's a trading sector, there's a tourism sector like a Siboney. Tourism is one. Of Siboney. We have a few, right? But there's a banking sector, there's a retail sector, and you have quite a number of sectors there. And look at how would the high interest rate environment affect each sector. And you kind of figure that out or call the broker and ask them, right? And then you decide on how do you allocate a fund. Now, if another company is coming that is in that sector, usually an IPO is quite speculative in the initial stage. That's normal in every market. So you might want to put some investment in there. Fine. But then after that, now you must ask yourself, of this amount that I bought in the IPO, let's assume the price went up. Do I sell some and reposition because I'm now overweight or slightly overweight in this particular sector? So as soon as the price goes up a week or two or so, you should sell some, not necessarily all because you're buying into the long run growth of the company. Sell some and put it into another sector to balance out your portfolio. It should be balanced across sectors, right? You're looking at dividend stocks. You need cash flow. So rather than take all the money and run into this highly speculative security, you need to buy some of these companies that are consistently old, listed from 2030 before your parents were born, that pays consistent dividend because they are very stable. They have a healthy balance sheet. They have a good cash reserve, right? They have an experienced management system, and they understand the market. So you want cash flow into your thing. This cash flow now will also help you with the next IPO. Right?
All right. So let me recap it. Orville, just join in. Big up yourself, Orville. So you're saying, Clive, for 2023, when we think about investments in equities, we want to start firstly by looking at companies that the price has fallen a lot, and we also want to look to the IPOs. You're also on top of that saying, well, we need a portfolio allocation. We need to set up our portfolio. We need different sectors.
Yes.
And we also need to buy companies that are going to give us dividends, passive income.
Exactly. And the role of that is not just to the dividend to grow your wealth, which is part of the whole portfolio strategy, but also it gives a cash flow. Because many times people are so excited about IPOs. Where do I get cash? We know that when there's an IPO, we see it in the marketplace. They sell out existing securities and price it times again.
Dividends, you can use the dividends for the IPO.
Keep the portfolio. Exactly.
Very smart, Clive. Very smart, coming from the JMMB expertise.
Yes, right. So what people, investors should do now, look at the markets just since week. We see some prices kind of easing down. We know that people are realizing cash to go into this new IPO, right? So look at those securities that are easing down in prices and decide, can I add them to my portfolio? Okay. Now, of course, talk about the global crisis. The MPC report just recently, the governor was quite optimistic, I believe. Yes, the rose interest rate because the US went up 75 basis points. So we would have to, we don't want $1 to devalue, so we would have to increase interest rate. But it was so interesting that he said other variables are operating at such a level that he believes that they might, he said that we will pause the increase in our interest rate because our economy seems to be fairly stable and on the rebound as a matter of fact. Jamaica just opened back. Jamaica tourism is growing. They're adding rooms as we speak. So it's not just stable, but they are growing. So that augurs well for our local market.
So I want to bring in our next guest expert into our conversation. We have with us tonight Julian Morrison, a financial services professional. Julian is manager of strategic planning and analysis and leads a team of analysts which assesses investment opportunities. He's also worked as an assistant manager of private equity, and he's a Prime Minister Youth Awardee in the category of leadership and is a sponsor trustee for the Women's Center of Jamaica Foundation Pension Fund. He's a board member of the Caribbean Coastal Area Management, and that company has oversight for Jamaica's largest protected area, Portland Bight. Julian is also a former curator of the Global Shapers Kingston Hub and is a former head boy at Arden High School. Okay. And is very passionate about financial literacy. I want to bring him into the conversation as well because I want his views, his independent views around the outlook. So welcome, Julian. Big up yourself. Welcome to the Money Classroom.
Hey, good night, everyone. Keisha,
Welcome,
when I was looking up your profile, I saw so many investment charters. I was like, yo, Keisha is a beast. She's way too humble.
Yes, I have. Yes, I know a lot. And we're bringing
CFA,
in our
empowering everything.
experts into the
Yeah.
money classroom as well because we have to talk the things about money. That's why people are here to learn, to apply, and to build wealth. So Clive gave a lot of his views, Julian. I want to hear from you. What's your assessment of the financial markets in Jamaica and internationally? What are you seeing?
Right now, there's a broad-based slowdown in the equity market locally. Notice that the average size of trades have reduced gradually since the start of the year. Meaning from the start of the year heading towards the end, we're now in November, and we notice that the market is pretty much softening. In terms of the size of the gains that investors can get on the average plays that they would make, even on the junior market, they have started to shrink. And that has a lot to do with a couple of factors. Um, but I'll deal with the junior market separately from the main market. On the junior market side, the structure of the market is such that we have mostly retail investors driving the activity. And I think that cost of living is starting to play a role in terms of market participation. So, because inflation has come in so strongly for so long, I think that it has caused investors to change their priorities in some cases. And we have a labor market that's still strong. Our unemployment rate is still below 7%. It's about 6% now. So on the face of it, employment conditions are still strong in Jamaica, but the fact is wages are not catching up with inflation. So there are persons who are starting to cut back. And I think a lot of the activity that happened this year had to do with IPOs, new listings, and companies that listed recently, and a couple others that wouldn't have fit that criteria that might have had their own audience. So you have some stocks that have a fan base, and they're separate and apart from the company's fundamental value. So here are the numbers, the profitability, the management team, the plans that the corporate team might be making and executing across the board, whether it is in Jamaica or in other territories to make growth happen. That's one side of it. And the other side of it is just the stock's fan base. And some stocks just have a fan base, like CPJ, it has a fan base. I'm not necessarily a fan of CPJ, but that doesn't matter. It has its following. There are a few others. Fosrich has a fan base. Fesco has a fan base. There are a couple others. So
we have a question on Fesco. I want to take this one. So because we have the IPO, the Regency IPO. No, and then we spoke earlier about the Russia-Ukraine war taking most of this year. From February 24 to now, war been going on, war, never ending. So Terran Square is asking about linking now the war to Fesco's stock price and to the upcoming IPO. I'd love to hear you guys, both of your views on what will likely happen for these two companies given that the war is ongoing. Another thing as well, we're in winter time. More oil is being used up, more energy used up for heating. It's me, my sweater here, where I use energy, right? What are your views? I'm going to start first with Clive and then come to you, Julian, for your views around Fesco and Regency's IPO price based on energy prices.
Okay, well, I have not done my analysis on Regency as yet, just pulled out the document yesterday. They're, based on what I've seen, their industry slightly differentiated. One is really on the retail sector where motor vehicle, gasoline, etc. And the one is the refilling of LPG. I'm not sure if that is it. Not is LPG, yes. Most of household use. As to how how it is going to grow and build out its business line, value added, go across the sector, I'm not too sure as yet. I need to look at the prospectus and say how. But the proof is in the pudding. Fesco has done quite well. Their margins have increased, but it's not just on the cost of energy. They really have had a strategy in diversifying and spreading across the country to take advantage of whatever opportunities there are, and they are so far successful at that, right? But I think they add new value and new diversification to the marketplace and to one's portfolio.
All right, I see there then. So, Julian, what's your take on what's going to happen with energy companies, given that the war likely going to go on into 2023? I don't see much signs around resolution, very small, but assuming that it continues into 2023, how would that impact Fesco and Regency's IPO?
Okay, so I'm in agreement with the thesis that the war is going to persist into 2023 because the driver is geopolitical. It's not an economic driver, it's a geopolitical driver. And those factors are coming closer to a gridlock and they won't be resolved soon. So given that we have agreed on the war continuing, I have done some reading, I've done a little homework. So the average price for the West Texas Intermediary Index for oil prices came out at about $96 per barrel in terms of the average price for 2022. And the forecast for 2023 is expected to be around $87 per barrel. So that is about a $10 difference, $9 difference, give or take. And that has a lot to do with the global economy slowing down, which should reduce the consumption rate of fuel. But despite the economy slowing down on a macro level, so we have China producing less and we have the US economy slowing down in terms of consumption, spending, etc. We still expect the inflationary drivers to be strong enough to keep oil prices at a certain level relative to supply. So, because most of it is a supply story, and we expect supply to remain so tight that prices should not fall below a certain level. And the forecast, according to my homework, is about $87 per barrel. So that is what we call a bull case or an optimistic case as it relates to the strength of oil prices. So that is beneficial to Fesco and beneficial to Regency. In terms of Regency, what's special about them is that they're at early stage growth. Fesco is a little bit further down the line. So think about it. Fesco has more than 7 locations island-wide, and they're going on to their 8th and their 9th. I don't remember the exact number, but I'm just throwing numbers out there. So they have a footprint that is island-wide or close to island-wide right now. As it relates to Regency, Regency just started, they just launched in 2019, and they had their first service station either in 2020 or 2021. So it's a very young business. And during the course of their next financial year, they're expected to complete 2 of their service stations that are currently under construction. So it means that by the end of their next financial year, they're expected to triple their capacity as it relates to their service station. And their service station revenues actually constitute the bulk of their revenues. Right. So the point is that is extremely beneficial to Regency because of how young the business is. So you're not investing in a startup, but you're investing in a company that's at early stage growth. So that growth pace is very aggressive. It's not common that you get a chance to buy into a business at this stage of growth that's already profitable. So pretty much there's a very strong bull case for the company. The margins are not bad. Talking about gross profit margins, net profit margins. So if they can manage to maintain their liabilities and contain their expenses as it relates to their rollout and their expansion, then they should do fantastically. That's not me giving a buy recommendation now, because you should speak to a licensed financial
right.
advisor.
Go to, we have that disclaimer that comes out up front, so everybody know that, and they're listening, and it is upon each of us to put two and two together for ourselves. But what I wanted to draw everyone's attention to is that we spoke about the fact that the war is going to continue. We're talking about what to expect in 2023. Inside the money classroom, we have to put things together. We have to connect the dots to help persons to be better investors. So I'm very happy that you and Clive were able to shed light on that. We have another question now from Cheesy Gully side, one of our top students inside the money classroom. Cheesy Gully side is asking, if I am in a loss with some companies, should I just cut ties and reinvest in better ones or hold on? What should he be thinking about right now? When we look at global growth being a problem, inflation, interest rate, is now the time to be cutting your loss, to cut ties, or should we be looking to reinvest? Should we be going more into companies? I'll go with you first, Julian.
Okay, Cheesy. So the number one question is, why did you buy in the first place? Because when you buy an asset, you should think about your exit as well. So is it that you bought these companies with a view to hold them for 2 years? Or is it that you were looking for a specific return target? So you weren't limiting your investment objective by time horizon, or you're investing based on a target goal amount. So you want to hit 50% in terms of your portfolio value. Um, and you'd still want to guide that by some time horizon, but it might be, the point I'm making is your goal might not necessarily be time bound, but it is bound to a given figure or a percentage rate of growth. So those are some questions we need to look at first before we can answer that question. However, let me give you some additional information and context. If it is that you believe that it's a solid company that is going through a rough time because of market conditions, then fine, it can be patient, right? Because think about it, JMMB and NCB, they won't likely continue to languish in terms of their price forever. There's going to be a day when those stocks say a breakout. But do you have the stomach to build a position in those stocks and wait it out, regardless of what the crowd is saying? That's number one. Number two, within the context of you looking at your time horizon, is it that you wanted to invest for 2 years and year one didn't go according to plan and you have 1 year left? Do I need to make up for my disappointing year in year two and I need to reposition? So in a situation like that, we wouldn't necessarily go with the first tidbit where we're going to rough it out and basically say, okay, we're going to build our position and hope for the best. We're going to look at the stocks that, one, have a fan base, two, the stocks that you actually understand. So you understand the return drivers, you understand the risks, you understand how they make money in simple language. And once you tick those two boxes and you're able to follow that company's financial performance, as well as understanding the fact that it has a fan base, then you could rotate out of some of the stocks that haven't performed so well and move into some stocks that meet the criteria that we just discussed. The stocks that have a fan base, they understand how they make money, and pretty much you are able to do the homework and to track the performance of these companies, because it's not a case where you can just follow the crowd blindly. In investing, you have to play your game. You can't play somebody else's game. That's a very dangerous thing to do,
I
because
like
if you
that. I like that, Julian. Play your game, stay in your lane. You have to know your reason, your motivation for investing. Cheesy. If the company is solid, you stick with them. If not, you have to reevaluate and make the decision from there. No, I wanted to get you guys' views now on areas of the economy that you expect to be struggling next year. What are these areas? What sectors? What probably some say Julian, our where we're going to see the heartache and the pain. We're gonna go with you, Julian. You see that you have something burning to talk about. Where's the pain?
well, in the Jamaican economy, um, we expect tourism to continue to roar. because of larger factors. So the point is, we are still benefiting from the post-COVID boom, and that trade or that opportunity is still likely to hold up even though the global economy is slowing down, right? So going through them one by one. Also, we should see some additional tailwinds as it relates to the post-COVID recovery in the services sector on a whole. But the fact is, we have to ask where companies sit in the services sector. Is it a company that is cyclical or non-cyclical? So companies that are cyclical are companies that basically fall as the economy contracts and they expand as the economy grows. So let's say, for instance, you have a company that sells products that people don't need, right? Let's say luxury products, and they sell diamond rings. You can imagine that when the labor market is stronger, the demand for diamond rings is going to be at a certain level. People have income that they can use to support a credit card and credit card payments, and they can go ahead and buy bigger rings because labor conditions are stronger. However, you have another company that sells toothpaste. Now, toothpaste is more of a staple. It's something that we use every day. It's fairly inexpensive and it's very simple to use. So you'll find that companies that sell staples or products that don't basically fluctuate with the economy, they have a greater tendency to hold up in conditions as the economy is slowing down. So you want to look at producers of staples, the sellers of staples, companies that sell necessities, or if it is not a necessity, it is an addiction. So for example, Supreme Ventures, they sell an addiction. Carreras, they sell an addiction. So you really have to look at the thesis and understand what is the driver from an economic perspective. So in summary, I anticipate that companies that sell things that people don't necessarily need, that don't have a strong franchise model, and they don't sell an addiction, especially if they have strong competitive forces, I expect them to perform less than the companies that don't fit that criteria set.
Nice. All right, Clyde,
Yes.
what are your views? What are the areas in terms of
Okay.
investment that you expect to do well next year?
Okay. Yes. Okay. Well, we can start with okay. The nature of what we're going through now, high interest rate environment, quickly and easily that impact financial sectors and companies that make up about, I think financial companies in total, including insurance, makes up probably about 45 to 48% of the main market index, right? That is of all in terms of the value, at the total value of all the companies. I think financial companies make up about 40 to 48% of that. Now we know the high interest rate environment will impact them significantly. Quickly, it impacts the balance sheet. Their asset has to be revalued, right? And then it affects their regular. Let's cut this. I mean, I don't have to go through all of that. But we have seen the impact already. It's difficult to collect money. Granted, BOJ says that their default rate has not really been impacted that badly in the sector, right? But we can say it increases cost and cut revenue quickly. And we have seen the reaction of some financial companies, and prices really have declined. I think JMMB, I think of all the financial companies have, in terms of prices, have done the best, you know. NCB kind of begun prior to COVID, and we understand why. Yeah, right. Proven price probably about a third, has lost about a third. I think it's about 20 cents, US cents. So that is impacted. But I think these prices are now at an opportune time to begin to buy back incrementally. That is average in, right? That's one. So those were impacted, but I think it's now time to begin to buy these stocks because the prices are really at low. Look at the average prices over the last, even pre-COVID, let's say post-COVID 21, 22, and then now, right? As Julian said, that there are some stocks, some sectors that are defensive. Food, retail, food establishment, Dermont Trading, Seprod, Grace, all these, they are really very defensive. Even in COVID time, they were impacted in the early stage because of the domestic logistics issue. Everywhere shut down. That is it. But quickly they rebounded. They saw their profits into 2020 coming into 2021. So those are defensive stocks. We know also, as Julian indicated, that there are some stocks. It's interesting. Supreme Ventures, I learned this and I did some research on it when, when they were coming public. Gambling establishments during times of tightness, economic tightness, do very well. People apparently gravitate towards them. It's
That's
interesting,
good.
right?
Yes, during the hardship. Here you
Yes,
go.
yes.
Buy
You see?
some cash
And
pot also. Yes.
yes. And then also, as indicated, the nature of some in the inelastic demand for some products. Cigarette smoking, I tell you, taxes have almost doubled, more than doubled on cigarettes over the last 5-6 years. You know, the government is taxing it heavily. It supports the National Health Fund, but yet still, the revenue, at least on average, has grown. Maybe a little bit tighter in the last financial year, but has grown. So the nature of those companies. And then, of course, the cycles now, we can look at other companies that when times are tight, where would consumers cut from? You know, entertainment might be one. Um, you know, so those are the cycles of some of these companies. However, again, we have to look at where we're coming from. The party scene, though, seems to be quite robust. So alcohol is also fairly defensive at all times. But in Jamaica's particular case, I think the party scene is kind of reactivated now, right? And earlier this, probably about summer, DNG published some results and said that domestic sales have gone up like 15-20%. Right? So those are the areas you look at to see what will do well even during an economic crunch, right? And you focus on those. Apart from that, though, just look at prices on the JC. Look at the companies, the fundamentals of the companies who have done poorly over the last year or so, who are more resilient, and then you can put some funds into that. This high interest rate environment is temporary. Even though there is talk of a recession, but it's 50-50 in the United States, and that impact the rest of the global economy, especially where flow of funds concerned. As interest rate goes up in the US, money will move from all over the world, including Europe, into the United States. And this is why you see the pound is devaluing against the US, as people are demanding US dollars because interest rate is going up. That's why in our case now, BOJ has to increase interest rate to make Jamaican dollar more attractive in terms of the interest being paid on it, so people don't run to convert their money to US, devalue the dollar, and move investable fund into the US. So what you find if the US kind of slows down somewhat, we might see our market come back and even a quicker and faster rebound. Luckily, however, the critical economic sectors in our economy that draws in foreign currency as well as employs a mass of people are doing fairly well, right? Mining and quarrying.
So hold on there. No. So we think through Clyde. Personally, you and Julian have done a really good job of highlighting sectors that would work well in the local markets for 2023. So person should be keen, I write down and make sure. But a lot of people are now investing on the international market. So before time runs out, I wanted to also touch on that and talk specifically around cryptocurrencies, because we know crypto's got beaten up a lot this year. Some people lose house and land and car. Some people have many sleepless nights, belly cut out because of what had happened with cryptocurrencies. Is 2023 the year that we start looking back to the crypto market? I don't know if you guys can speak to that. Should we now start slowly re-entering? What should we be doing when it comes to crypto? We'll go with you first, Julian.
Okay, so let's look at the thesis for crypto. So essentially, the idea is that where we invest in companies as it relates to stocks, we are investing in technological protocols as it relates to crypto. So the key is to understand what we're buying. So when we buy Ethereum, we should know the use case for Ethereum. We don't need to be computer programmers, but we need to understand the utility of the technology behind Ethereum to know if it is oversold or overbought. I mean, it's not going to have like a PE ratio or anything like that. But the idea is you still have to understand what you're buying. Bitcoin doesn't have as much technological applicability as an Ethereum. But what Bitcoin is that it is the grandfather of all other cryptocurrencies. So Bitcoin in the crypto world is used as a benchmark. It's almost like the reserve currency. Theoretically, that's how it is viewed. Therefore, that sets a price floor for it. Because if someone has a basket of cryptocurrencies that they've allocated their portfolio to, and they've decided to reduce their allocation to crypto, they will likely reduce their allocation to all the other non-Bitcoin cryptos and just keep Bitcoin alone. Or the reduction in crypto will be smaller than the rest. So it's key to understand these kind of things before jumping back into crypto. I think that crypto is largely interest rate sensitive, and I expect that the hiking cycle of the US Federal Reserve will continue into 2023. And given that the hiking cycle will extend into 2023, that is still putting downside risk on crypto. So if it is that investors want to short crypto, they can short cryptocurrencies and make money in 2023. However, if they want to look at it as a buying opportunity, say you want to build cash, wait on the sidelines and buy at lower prices, then you can also do that. So it depends on your appetite and where you're going. But in either case, the key is to buy what you understand. I don't expect a breakout in 2023 because of the hiking cycle. And of course, because of the issue around the failure of FTX and FTX adjacents, because the issue is contagion. There are so many other entities that were tied to FTX.
Yes, that caused
FTX is now dragging down, right?
Gotcha. So, Clive, what are your views? Quickly, what are your views on cryptocurrency? Now the time, run all in, like you said, IPOs and equities, get ready. Should we get our money ready for crypto as well?
Well, I cannot give advice on that, but what I can say though is that the US government seemed to have a renewed energetic interest because of the failure of FTX. That it's a platform, it is an exchange, and apparently FTX also has legitimate regulated entities, like any other financial institution. So it's an exchange, but it has subsidiaries that are legitimate trustees, fund managers, etc. And those are regulated, right? Legitimate regulated entities. And from what I've read, that they seem to be okay. Just reading an article yesterday. But I think the regulation, as it comes under regulation, I think we may say buyers settle down, that is investors settle down, and the price might just ease a little bit, right? It's difficult for me to say when to buy, when to sell. I'm still grappling with the compliance, the regulatory environment that it operates in. Me personally, as an advisor and a trader, as Julian has said, focus on the fundamentals, right? And part of my fundamental analysis is what type of regulation an entity falls under, and what impacts it. For example, can the Federal Reserve action impact it? In what way? So these are things that we have to understand first. Right. So
I think we need to talk about next year. Then I'll go in detail a crypto money classroom session so everybody understands what exactly we need to look for. So very good discussion. I thoroughly enjoyed this, and I know that everyone was busy writing and taking notes. Thank you so much for being on with us tonight. We had Clive Charlton, equity trader at JMMB, and also Julian Morrison, financial services professional. Thank you guys both for being with me on tonight inside the Money Classroom. Big up yourself.
Thank you for having us.
All right, take care, everyone. You hear it, you hear it, you hear it. You can't say never come to the Money Classroom and listen to Clive speak, listen to Julian speak, and listen to my views on what 2022 had in store for us and what 2023 would look like, and things that we need to start thinking about now to do in 2023 when it comes to our money, right? I just wanted to say, I want to give a special shout out, Senorita Cole Spaniel, tuning in from Japan. Welcome to the Money Classroom. I know you are very keen because just make sure it's on the whole other side of the world and you are here. So remember, everyone, like this video, subscribe to our channel, and share this with a friend. Anybody who you know that want to be a part of learning about investment, send them this video and say, look here, you better watch this, because this is what's coming in 2023. Get yourself ready. Also, this week, Wednesday, we're going to be having a very special event, Profit Jumpstarter Live. We're going to be talking about wealth strategies for the holidays. What should we do to make sure that the new year catch us with some money and we're not broke entering into 2023? We had Clive and Julian talk with us about things we need to think about so we can't broke. We can't broke. So join me this Wednesday. It's going to be streaming live to YouTube as well. Make sure you go to profitjumpstarter.com/live to sign up for this event where we're talking about wealth strategies for the holidays. Don't miss. As I said, to miss is to this. To miss is to make sure you have a broke Christmas and a broker New Year. So make sure you are here inside Profit Jumpstarter Live, where we're talking about wealth strategies for the holidays this Wednesday at 7 p.m. Jamaica time and 7 p.m. Eastern. As always, make sure you're connected with us on all the social media channels. We're Profit Jumpstart on Instagram, Profit Jumpstart on YouTube, Profit Jumpstart on Twitter, and of course, make sure you go to our website, profitjumpstarter.com, and hit up that newsletter. Also, as always, you guys know knowledge is nothing without execution. Yes, big up yourself when it comes to the new year. Cheesy Gully side, happy new year. I'm gonna be sending out all of the episodes from our first season. Can you believe it? 19 episodes of Money Classroom. 19 episodes. You're gonna be able to binge watch them all over the Christmas holidays and get ready for the new year where we're coming bigger, better with more information for you inside the Money Classroom. Remember, knowledge is nothing without execution. Use what you learned this week, implement it, go and build wealth. That's what we're all about. So thank you everyone for watching us. Until next year, I'll see you again. Bye.